Financial professionals, I bet at one point in time over the last couple of years, somebody has come to you and said, I'm selling my house for a huge amount relative to what I put into it. How's that going to impact my taxes, my Social Security, my Medicare? I know that I have on several occasions. Why? Because housing prices are elevated. Inflation has certainly taken hold in the real estate market. Heck, today, the median price of a home throughout the United States is like $460,000. So when somebody sells their house for this, when they put in this, how does that impact the rest of their tax situation? That's exactly what we're going to talk about here, folks. By the way, my name is Charlie Gipple, the owner of CG Financial Group, your independent marketing organization for annuities, life, long-term care. Remember, if you like this video, give me a thumbs up as well as subscribe. So here's a real case scenario. My client, who I will call her Bev. Bev comes to me and says, hey, I'm selling my house out in California, selling it for $1 million. I have $250,000 in it. So that's $750,000 in gain. So the CPAs or tax junkies that are listening to this video, question for you. She has lived in that house for like 30 years. It has been her primary residence for 30 years. She is single. She sells that house for $750,000 above what she put into it. What is the tax liability? The answer to that question is $500,000. We're talking federal here. California, we could split hairs. We're talking federal tax liability here. $500,000. Why? Because the exclusion for a single person is $250,000, assuming they lived in the house for 2 of the last 5 years, et cetera, et cetera. If she was married, it'd be $500,000. So she says, so that's $500,000 that's added to my income for this year. I said, well, not income from an income tax rate standpoint, but it is added technically to your taxable income. Then that taxable income splits out capital gains, long-term capital gains, and your income. She goes, okay, so does this additional $500,000 in income, in addition to my little $40,000 I have coming in Social Security, as well as some income from my securities, what's that going to mean on my $40,000 in the tax rate there? I mean, am I just going to be paying taxes like crazy? Heck, I mean, is all of my $40,000 that I live off of, yes, it's great to have all this that I'm selling the house for over here, but am I going to be completely nailed by the IRS? I said yes and no. Let me explain. So folks, what she's talking about here, a very astute question is this. Over here you have income taxes. Let's say that her taxable income is $40,000. And let's just call that somewhere around the 22% tax bracket, right? What she is asking is this. So now I have $540,000 to oversimplify, not getting into standard deductions and all that other stuff. $540,000. So what she's asking is, am I all the way down here on my $40,000? The answer to that question is no, she's not. Here's the sequence of events. You have taxable income, which is a lot. Let's simplify and say $540,000. Income taxes are applied first, right? So her $40,000 is going to be applied to what you see here on the left-hand side. She's a single filer. By the way, I don't know if I mentioned she's a 73-year-old single person, beautiful human being. What about the capital gains then? She's got $500,000 in capital gains over here. By the way, immediately my question was, well, with other advisors that you've done business with, do you have any securities that have lost a lot of money over there because long-term capital gains minus or long-term capital gains, then you subtract from that long-term capital losses, short-term capital losses, their tax loss harvesting strategy. She says, no, I don't have anything like that. Okay, well, I digress. So over here on the capital gain side, she goes, okay, so what tax bracket am I going to be in? Well, you have $540,000 that's reflected over on the right-hand side. So in short, Bev, your large capital gains does not impact the left-hand side of the equation, your income tax bracket, but your income in addition to your capital gain of $500,000. That's what determines your tax bracket over here on the right-hand side when it comes to long-term capital gains. I said, so call it 23.8% because you have 3.8% Medicare surtax plus the 20% you're paying over there. She goes, okay, it's kind of yes, kind of no. I said, yeah, but we're not done yet. Why? Because you can bet that your adjusted gross income is a heck of a lot more this year than what it's been in previous years. Let's call it $540,000, again, to oversimplify. Your provisional income this year is going to be huge, which means because you're above $34,000 in provisional income, you can plan on paying taxes on 85% of your Social Security. But then in addition to that, in the year 2024, because it's 2 years behind, Medicare premiums are going to go up, so you're going to end up paying a lot more for your Medicare in the year 2024 because, again, they go 2 tax years back. Folks, that was a high-paced deal here. Feel free to rewind if there's something you're unclear on. Send me a message. If you like this video, give me a thumbs up. Subscribe if you like this video. And heck, use CG Financial Group as your independent marketing organization for annuities, life, long-term care, because I do these videos pretty much every week.